A futures contract is a type of financial agreement between two parties to buy or sell an underlying asset at a predetermined price and date in the future. Futures contracts are commonly used by traders and investors to manage risk and speculate on future price movements in a wide range of financial and commodity markets. In this video, we'll explore the basics of futures contracts, how they work, and the key features that make them unique. What are futures contracts? A futures contract is a legal agreement between two parties to buy or sell a specific asset at a predetermined price and date in the future. The underlying asset can be anything from commodities such as oil, gold, or wheat to financial instruments such as stocks, bonds, or currencies. Futures contracts are traded on exchanges, such as the Chicago Mercantile Exchange or the New York Mercantile Exchange, and are standardized in terms of contract size, expiry dates, and delivery specifications. How do futures contracts work? Futures contracts are typically used by traders and investors to manage risk and speculate on future price movements. For example, a farmer may enter into a futures contract to sell a certain quantity of wheat at a specific price on a future date. By doing so, the farmer can lock in a price for their crop and protect against potential price declines. On the other side of the trade, a speculator may buy a futures contract to profit from an expected rise in the price of wheat. If the price of wheat increases, the speculator can sell the futures contract at a higher price and make a profit. Futures contracts are settled on a daily basis, which means that gains or losses are realized each day based on the difference between the futures price and the market price of the underlying asset. This process is known as marking to market. Futures contracts have several key features that make them unique compared to other financial instruments. Standardization. Futures contracts are standardized in terms of contract size, expiry dates, and delivery specifications. This makes them easy to trade and ensures that all parties are on the same page. Leverage. Futures contracts typically require a small amount of capital to control a large amount of underlying assets. This leverage can magnify both gains and losses. Margins. Futures contracts require both the buyer and the seller to put up a margin, or a deposit, to ensure that they can meet their obligations. Margins can vary depending on market conditions and the volatility of the underlying asset. Delivery. Futures contracts can be settled by delivery of the underlying asset or through a cash settlement. Most futures contracts are settled through a cash settlement, which means that the buyer and seller exchange the difference between the futures price and the market price of the underlying asset. Futures contracts are a powerful financial tool used by traders and investors to manage risk and speculate on future price movements. They are standardized, leveraged, and require margins, and can be settled through delivery of the underlying asset or cash settlement. Futures contracts can be complex, and it's important to understand the risks and benefits before trading them. With careful consideration and proper research, futures contracts can be an effective way to achieve your investment objectives.